Major banks, Morgan Stanley and BlackRock, both downgrading the global growth outlook, no longer favoring emerging market equities. Joining us now is Eli Pars, Calamos Market Neutral Income and Hedged Equity Funds lead manager. We just had a guest on in the last 15 minutes who said they saw opportunity in some emerging markets, but should what we're getting from these big banks, at least their downgrades, be of concern?
You know, we're a little less focused on EM than we are domestic, but you know, the global growth situation is something everyone's watching pretty closely. Playing out, you know, how trade plays out over the next 6 months will be a key driver of that. But you know, generally we're bullish on global economies, particularly the U.S., and some of that I think flows through to the EM markets.
So, Eli, from what I can tell from what your funds that you manage are designed to do, is it sort of market agnostic, so to speak? In other words, it's designed to sort of perform well no matter what the market is doing, or it's a market neutral income fund. So how exactly does that change, especially when you have a market that is near all-time highs?
Yeah, exactly. Market neutral income is really designed to earn a return, hopefully independent of the movement in the broader markets, particularly on the convertible arbitrage side of the strategy, where we're buying convertible bonds and shorting the underlying stock to create a neutral hedge there. We're looking for volatility. We generally benefit from volatility in that strategy. So periods like what we've had over the last last couple of years have played out pretty well for us. On the hedged equity side of that, which we offer in the market neutral fund as well as in a standalone hedged equity fund, it's really a low vol equity strategy where we're trying to, you know, earn a good positive return in an up market, but protect to the downside. When you put those two together in market neutral income, the return stream tends to look like fixed income used to look like back when bonds had a bigger coupon. And so we've seen a lot of interest from investors who are looking for alternatives to fixed income and have chosen market neutral as a way to achieve that.
You mentioned you were bullish on the U.S. Why? The data is crumbling. Companies are out here warning. Why are you bullish?
Yeah, I think we're probably less week-to-week focused than maybe what you're talking about, and we'll see what Q3 earnings bring through. But growth is still pretty reasonable. Valuations I think are pretty reasonable. They're not anything like we've seen in other market tops. There's very little euphoria. No one's asking me for stock tips when I walk my dog, which is very different from the 90s. So all of those things together, I think, make us, feel like, there's decent opportunities in the U.S. I feel like some of the slowdown we have seen this year is maybe trend growth isn't as good as what we were experiencing last year, and now we're pulling back a little bit to that. But still, it's probably the only market in town that's delivering reasonable growth, certainly in the developed markets.
I'm curious, with the Calamos Hedged Equity Fund, what kind of returns, if I wanted to protect myself, could I be looking at, say, over a 10-year span? What do you tell an investor who might come to you on that question?
Yeah, you're trying to ideally capture, 50, 60% of the upside of the market and protect to the downside, delivering less than, maybe less than 40% of the downside. It can be volatile on a quarter-to-quarter basis, but generally it's going to be a lower beta strategy in the broader market. We think it works pretty well for investors who are concerned about what's going on in the market and want to take some money off the table, but don't necessarily want to, completely leave equities. Mm-hmm. You look at prior bull markets, take the 90s, for example, the last couple of years of that bull market were very profitable, but very volatile. And so being able to stay in the market, but in a more volatility and risk-managed way, is, we think, a compelling conversation to have.
And you were talking before about an equity strategy that protects against volatility. How does the Fed possibly cutting interest rates play into that?
Yeah, we'll see what that drives the broader market. I mean, it feels like there's at least a 25 bip rate cut already priced into the market. So we might see a little bit of sell the news reaction to the Fed if they do indeed cut here in July. But that's what we think. All the confusion about what the bond market's telling us versus what the jobs report last week tells us, very conflicting measures of what's going on in the economy. and the Fed questions about what the Fed's going to do, all these things together are going to mean more volatility, which is normal in the later stages of a bull market, that you see more volatility. And we think being in strategies that protect against that makes some sense.